What a week. The first question, I would just love for you to sum up, if you can, maybe in a sentence or two. What is your reaction to what's happened this week?
Combination of Fed policy error and individual bank risk management failures. So I see a lot of people blaming, either the banks or blaming the Fed exclusively, whereas like most things, it's a mix. And so basically, it's kind of a toxic policy combination and just individual bank mismanagement.
Hi, I'm CryptoPositive. If you like this video, please leave a comment and subscribe to the channel. It's very important to the channel and gives me motivation to make more videos about crypto for you. And now let's go to the video.
Are we at the beginning of another real financial crisis?
I don't think not in the same way in 2008. In some ways, it has parallels to the 2019 repo rate spike, which not everybody's familiar with. But it's more severe than that, but not as severe as 2008, at least in the United States. And the reason I would describe it like that is 2008 was really a credit problem, which means that banks made very aggressive and ultimately bad bets. They lent money to entities that defaulted. Whereas here, we're not really seeing that. It's not like they got overly aggressive and made bad loans that are defaulting. Instead, what they did was they ironically bought very, very safe assets, but they bought them at high prices, meaning low yields. And as yields have gone up at like a multi-decade high rate, a year-over-year rate, a lot of those securities are now underwater in price. And it's actually fine if they're able to hold on long enough because those securities will pay back all their money, or at least, the vast majority of them. The problem is that if they can't hold on long enough, if their deposits get pulled out and they have to sell their assets for a loss, that's when they basically make those losses real. Kind of a secondary and longer term problem is that if deposits flow out of smaller banks and towards the larger banks or the money market funds, then those smaller banks have to raise deposit rates in order to entice capital to stay there. And then the risk there is that they hurt their profitability because they're holding these low yielding assets, probably till maturity, at the same time as they're paying out higher deposit rates. So I would say this is essentially a shock to the system when you raise rates this rapidly, and then it kind of finds out which banks manage that exposure better than others.
Well, let's dig in a little bit with Silicon Valley Bank, because that was sort of the first domino, and exactly what you just mentioned happened. They essentially bought these long duration bonds because they were chasing yield in a zero interest rate policy environment, and then they had to go sell them when depositors came and wanted to get their money out. Can you paint the picture of, pandemic started, fiscal stimulus goes into motion, and all of a sudden you have PPP loans and stimulus checks, and those are all going to these banks, right? So that's where all of a sudden they were flush with cash. They were buying up these treasury securities. And then when did the problem sort of surface as the interest rate hikes started?
Sure. Yeah. Basically, to zoom out, there is like that 40% increase in the broad money supply in a very short period of time. And most of that broad money supply is bank deposits. So banks, even though those are customer funds, those are liabilities for the bank and they're holding them for the customer. So they basically had an influx of deposits and they had to invest them in something. And a lot of them put them into relatively safe securities, things like treasuries or mortgage-backed securities, which are among the safest assets that a bank can hold. The problem is that those have duration, right? So they might be like five.
Before we get back to the video, I want to tell you that you can get a free $100 bonus from iTrust Capital by clicking the link in the description right now. Now let's get back to the video.
Year, 10-year or longer duration assets. And you had this record increase in the broad money supply, super low rates, and then it led to inflation, among other factors. And so the Federal Reserve freaked out and completely, 180-degree reversed their monetary policy. So they started sucking money out of the system, and they started hiking rates at the fastest rate since the 1970s. And so all these banks that bought these longer duration safe assets suddenly found their positions underwater. Now, there's two big risk factors that go into why this particular bank had such a big problem. One was that their deposits were not very high quality because they were concentrated in one industry, tech startups, And because they're mostly business bank accounts, most of them were well above the FDIC limit. And so they had, they're at risk of loss if there should be a bank failure. And so they're basically deposits that are very, very quick to want to move at any sign of a problem, which is not the case when you have a very diversified and smaller, kind of a large number of small accounts. So one is their deposit base was at risk, and then number two is they did not manage their duration well. A bank like JP Morgan, for example, got more into shorter duration types of assets. So they had less losses when interest rates increased so much. Whereas this particular bank, basically made a pretty big bet on long duration assets, which is not like the riskiest thing you could have done, but it is risky because those are relatively safe assets, but they have pricing risk. And so that bank had a particularly large amount of losses relative to its capital and had a very flighty deposit base. And a number of other banks that either were taken down or were kind of on the verge of going down had somewhat similar risk profiles, both in terms of the deposit side and the unrealized losses side. Whereas banks that have held up better are ones with either a more diverse and larger deposit base, and that have less losses because they in general because they bought shorter duration securities, or a lot of their assets are their own loans on their book and therefore aren't really marked to market in the same way.
Well, and when SVB had to go sell those long duration bonds, they had to mark to market. So they were at a loss. They tried to raise equity and they couldn't. So is that essentially how they collapsed that weekend? And then the government stepped in?
Yeah, that's basically what happened. And then there was a big decision of whether or not they want to back up all depositors, because most of them were uninsured. But at the same time, the policymakers want to restore confidence in the rest of the banking system. One of the big challenges is that, of like the 17 trillion plus deposits that are out there, the FDIC only has, less than 1% of those deposits backed up by insurance. Even the ratio that is fully covered by insurance, they only have something like 1.3% covered. Now, to their credit, I mean, since 1933, they've never not paid on a insured deposit before. But basically, it's one of those things that they don't want huge, vast bank runs happening. And a lot of this is a confidence game. That's kind of the whole game of fractional reserve banking, is that these institutions are inherently unstable. I've described it as basically like we're all just casually storing our money in leveraged bond funds. And so obviously that's, if you phrase like that, would you say, is that a low risk investment? People would say, no, of course not. But that's what we all just casually use for our, savings. You would just put grandma in a highly leveraged bond fund, and that's where she holds her money. We kind of normalize that. And so they wanted to backstop confidence in the system. And they've also added this liquidity facility. It ironically generally benefits the larger banks because you can only use that facility if you have a lot of high quality liquid assets. And whereas if you look at the long tail of smaller banks, they're generally more loan driven. They hold illiquid loans that they made and that they're not really easily resellable. And so they can't use that particular facility. And so I think we're in an environment where the large banks are pretty well protected, whereas small banks probably still face ongoing challenges.
Is the government's intervention in this case a bailout?
Partially, yes. I mean, basically, the non-insured depositors, they would have gotten most of their money back, but based on the losses that the bank had, they would not have likely gotten 100% of their money back. So that was that's basically socializing losses. Basically, other banks are going to absorb that cost over a wider base to get those uninsured depositors whole. So that's number one. And then two, this facility that the Fed and the Treasury put in place.
The BTFP?
Exactly, yes, that facility. That is sort of a bailout in the sense that it's not free money, but it is selective access to below market credit at above average terms. So basically, it's easier credit than they otherwise would get on a open market basis. Now, if you zoom out, I mean, the whole system is kind of artificial, right? I mean, when all these banks are building their system on top of the Fed, and the Fed is actively managed by a central entity, it's like both sides are bailout. The whole system is kind of one giant ongoing bailout. But yes, this particular action did have characteristics that were at least partially a bailout.
And when the president went on camera and said that taxpayers will not be paying for this, is that disingenuous?
It's one of those things around the margins. It's different than if they just outright gave the money. I would say that people are going to pay for it, not necessarily through the government budget. They're going to pay through it by their overall cost effectiveness when using banks in general. The Federal Reserve's liquidity facility is backed up by 25 billion in Treasury capital to absorb any losses that they might incur, which seem somewhat unlikely. And so overall, taxpayers are not really sort of taking a direct hit from this, but it is a spread out cost among all market participants.
So going back to the BTFP, why are foreign banks eligible? And maybe let's touch on what's happening with Credit Suisse, because it seems like the European banks now are imploding.
So foreign banks, some of them have branches in the United States, and they tie into the dollar-based system, and so they're able to use that facility similar to how domestic banks can for similar purposes, because otherwise you have the long chain of offshore dollars kind of coming back and causing problems in the domestic banking system. As far as Europe is concerned, that's more of a developing story because that's really happening today. But it's kind of bringing up old wounds. I mean, Credit Suisse, for example, has just been this ongoing slow motion train wreck of losing deposits and basically it's becoming riskier and riskier, losing its major investors, and so that's been kind of an ongoing. Everyone kind of assumes that's eventually going to fail, even though it's a systemically important bank. The question is, what does eventually bring it down, or will it be kind of gradually broken up and somehow just absorbed into other banks? Like how's that going to be handled precisely? But basically, the problem is that if you're a European investor, it's actually harder to get a bailout in general because there's not one country with the government and the central bank on the same page. Instead, they have a bunch of different governments, and then at least for most of those countries, not Switzerland, but most of the countries, they have one central bank, and so their banks are actually more at risk of basically a failure, more risk of having a bail-in rather than a bailout, which is basically where the depositors bail out the bank. And so the challenge there is that suddenly kind of overnight, everybody has to be a bank expert and has to look at their banks, their financial filings and determine whether or not they feel safe holding them. Basically, if someone invests in a leveraged bond fund, you'd expect them to do a lot of due diligence on the risk of that asset. Whereas that's not, of course, how most people treat banks because, they partially because they're insured, but also partially because they're just supposed to do the services we expect.
Пустой зал, ожидание вокзала. Стою и смотрю куда-то в сторону перрона.